Oh, you're an entrepreneur? Oh, you're a real estate investor? Oh, you're trying to learn from those who did it? Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today, I have the pleasure of having Scott Meyers in the lab with me. Scott, first of all, welcome to the lab. I know we're overdue. We had to reschedule this, but I was anxiously waiting because this is one of the ones where you're bringing in a very unique subject matter expertise into our lab here today. And I definitely want to give you a chance to introduce yourself and welcome you to the lab, Scott. How are you doing today?
I'm doing fantastic, Ruben. How about yourself?
I'm fantastic as well. As we were saying, here it's a little on the colder side, but you can never stop from getting into the studio and getting on a good old podcast to deep dive a little bit on your expertise. So I'm excited to be here.
Looking forward to it.
So I always like to say, your reflection. I believe that people's businesses are a reflection of how they operate. So why don't you try to give the people a little bit of a background, because obviously we're gonna fast forward into where you are today, which is a very remarkable achievement and portfolio of all your real estate. But I want to take a little step back of who Scott Meyers is, who Scott was, and where he is today at a quick high level.
Sure. So, I think everybody has a story as to how they get to where they are today. And mine is one that I grew up as a junker. I used to fix bikes when I was young, and then I made money at that, selling them. Then I did it with cars, and then I started doing it with houses and then apartments, and then ultimately into self-storage. But, stepping back a little further, when I started in real estate in '93, started buying houses on, lease options and rehabbing them, renting them out, and just continued to do that until we had about 80 houses and just didn't have the cash flow and the money that we thought we were going to have and the free time. And so we thought, well, apartments will cure this, and the economies of scale that comes with buying multiple units and putting property managers and management companies in place. So we grew that to about 400 units, and only to find that, at the end of the day, you can have good managers and management companies, but the buck stops with you. And we still had to write the checks when things went wrong and clean up all the messes. And so, we love real estate for all the reasons that everybody does. And that is, it appreciates, and we can write it off for depreciation, and you put renters in your real estate and they pay down the basis or pay it off. And, then when they are paid off, you've got that passive income, even though you still have to spend some active time on it. And it'd all be great if it weren't for tenants and toilets and trash, right? So, either parking lots or self-storage were really the only other options, in my opinion. So I began looking into self-storage and bought my first facility, and never looked back. At that point, then we began selling off our houses and apartments while ramping up the self-storage side of the business. And that brings us to where we are today. We've got 2.2 million square feet of self-storage across the country, about 13,000 doors and growing. And along the way, we created an education business and a consulting business. And I go out and speak. I'm an author for Forbes magazine, and I speak at the trade shows and industry events and write articles. And so now we're in really all things self-storage. I live, eat, and breathe the business.
That's fascinating. I'm glad you touched on that right away, and you didn't waste a second. No, tenants, toilets, and trash. I love that. Because I think that's got to be branded or trademarked or something, by the way. But
it is.
It is. It is. I knew I wouldn't put it past you. I know you know better than. So let's talk about that, because you just said something very key. You said it sounded like you liquidated your other assets because this was just so. I mean, and I love that, because again, people come in and they say, hey, I want to get in real estate, and that question, is such an ambiguous statement.
Sure.
And now we start talking about a scalable business niche type of real estate. What did you see that made you think, this makes more sense to liquidate my existing, again, typical, I don't know if it was multifamily apartments or single family?
Single and multi.
Single and multi, what everyone's raving about, right? When we talk about real estate, to go into self-storage, which I feel is a very niche. So what is it that if someone's listening, like, why would Scott do that? What was the big why for you?
So I think everybody gets into single family because that's the best place to start. You can't walk into a bank and, buy a multi-million-dollar, commercial, any type of real estate, whether it's a, self-storage facility or an apartment complex or retail. You have to start in single family. So everybody defends the decision that they made because they have to. And so we all start there. But then, that business is tough. So if you're going to build a rental portfolio, that business is tough. You got to slug it out for a while until you get that critical mass where you can then begin to get some help on the management side to field the calls, to be project manager and, to oversee the management of those rental units. Otherwise, you are handling most of that, or you and your spouse or somebody along the way is going to have to come in and help with that, but you still end up with quite a bit of the work. And then when we got into the apartment side of the business, again, it just kind of magnified that. And even though we had more help and managers, at the end of the day, people can still trash your place. They cannot pay. It takes 45, 60 days to move them out. And the courts and the eviction laws, and some states are better than others, and many states are worse than others. But at the end of the day, those laws are meant to really protect the tenants from us big bad landlords. And so somebody could, take a claw hammer down, the entire inside of the house and rip out all the drywall and leave the door unlocked and the tub running because they're mad at me because they didn't pay their rent and we're evicting them. And we go to court and that's they got evicted and they owe us for the repairs and the back rent. And the court says, well, that's non-payment of rent and, perhaps excessive wear and tear, but you were going to fix that anyways. And I walk out with a little yellow or pink piece of paper having to fix all that and with little ability to collect that money. Yeah. And so I realize at this point that, even the best cook in the world can't, fix a broken recipe. And when the courts tell you that somebody can legally steal from you and destroy your property, then I think it's time to move on to a different business model. And so in self-storage, it's the complete opposite. If somebody doesn't pay, we put a lock on their unit. That's legal. It's by the lien laws because we follow the lien laws, which protect the investor or the owner versus habitational laws like the eviction laws, which protect the tenants. And so when somebody doesn't pay us, we put a lock on their unit. And if they don't pay, and if they don't pay after 90 days, we sell their stuff off and recoup their money. And then we open the unit up, we blow it out with a blower. And then 30 seconds later, we're moving in the next person waiting in line because it's a metal box and a concrete slab. There's no drywall, there's no carpet, there's no, repairs to appliances or anything else. And so once I saw the way the self-storage industry operates, I said, yeah, this is for me. This is the way to be in rental real estate when there's nothing to destroy. And if they don't pay you, you lock them out and you sell their stuff to get your money back. So that is what drew me to self-storage and ultimately for selling everything else off and going full bore 100% into self-storage.
I love that. And going all in. And I'm going to get to the, resistant to recession and all that. And because I think that's very relevant during these times of what we're experiencing. And I'd love to for you to share your experience, because I'm sure it's a little bit different, but I want to get back to a key point that you said in the beginning. You said commercial, right? And then you talked about, it's what we know, right? And typically people are going residential because again, they have a place to live, they put a roof on their heads and they think that's the easy way to go. Let's talk about the other scenario. Okay. So getting your first commercial, I know in the commercial world is a little bit different, right? There's asset-based lending, right? Is that still the case? Because I know in multifamily, that's also commercial, more than 4 units, right? But you're in a different type of commercial. So when you're going to a bank, what what are they asking for? Is it still what Scott made, or is it what that existing maybe business is making? And maybe we can break those two in half. Maybe it's an existing one that has some grossing some income, or maybe it's one that's raw and hasn't gotten even a start. So let's talk about that financing piece.
Sure. No, really, really good question. And I think many people out there think that they have to pay their dues and they have to slug it out in the single family world before they earn the right to even, darken the door of a bank and say, hey, can I have some money for an apartment complex? Where it's much easier than you think, because commercial lenders in general, let's talk self-storage, multifamily, retail, office, all of that. Banks are typically, when they do their underwriting, they're underwriting the project more than they're underwriting you as the borrower. So they're always looking long-term, and they're looking, down the road, worst case scenario. If everything goes to heck in a handbasket, if we have to take back this self-storage facility, this apartment complex, this office building, well, we'll put it in receivership. We'll put a property management company in place, run it or lease it back up again, and then we'll sell it with this. And it's got an income stream on it, most likely still. with a single family house, if it's run down and the person doesn't really take care of that business, whether it's one or many, and they lose their tenants, well, you lost one tenant, that's 100% of your income in a single family house. And if it sits vacant and perhaps the utilities are off, and if you're in the cold weather climate, pipes are frozen, and the bank takes that back, there's no income coming in on it, and they have to put money back into it to then get it up to the place where they need to sell it again. So commercial, quite honestly, is much easier to get financing than it is in the single family world. Now, if we parse self-storage outside of that, you're right, Ruben, that the commercial finance industry, sector looks at self-storage a little bit differently because it is somewhat of a business and real estate. Of course, a self-storage facility with nothing but garage doors on it. I mean, what else can you run it as a self-storage facility? However, the good news is we can split that for property tax purposes, and from lending standpoint, the SBA has a program, because they treat self-storage as a business, that will go up to 90% LTV, loan to value, on an existing facility. And you won't find that in, not many banks are offering that in houses or the commercial real estate asset class in general, except for storage. So it does have its benefits in terms of going to bankers as well. So I think I answered your question, but just to summarize, folks, if you're looking to get into commercial, don't wait. If you get a good project, you'll find the funding for it. And if you have to bring in a partner or a guarantor or some additional cash to the table, if it's a good project, you'll find that as well. But we have the added benefit in self-storage, in that there's more programs out there that are very, very favorable to self-storage, and which leads into your next question, Ruben, and that is, because self-storage is so recession resistant, that banks, this is the asset class that they're throwing money at. They want more of these deals on their balance sheet.
Gotcha. And so I want to take a little step back, because we do like to get a little tactical, like I can take this information right away, run away with it, maybe book a call with my lender and find out what the heck I'm doing, playing the wrong game here, for listening to Scott. Because it is, you hear it and it's like, well, why aren't people doing more of it? So, and that's always, again, obviously a very interesting question. Was why we have this show, to get insight, plant that seed. So if I'm going to tactically take that next approach, you talked about partnering. Let's get a little granular on that. If I do see a deal or a potential storage facility, and should I, what is the expectation? Should I be looking at a certain occupancy level that, are the banks looking at that specific? Are they looking at gross operating income, overhead? Like, what are they looking at? That's a little bit different when people are listening to multifamily and they know about the property management and all that. Like, what are some things going into that meeting that I should be prepared about? The numbers I should know, my credit profile, maybe, like if I need one. Can you get a little bit granular on that?
Sure. And I'll also take one step back to something that you touched on, and that is, I think many people, unlike when they're going out to buy the first single family house or even their own house that they're going to live in, they think they need to go get pre-qualified and talk to the lender and say, here's my income, here's my balance sheet, how much can I afford? Banker, if you were to walk in and say, how large of a self-storage facility can I buy? They'll say, well, that doesn't, we don't do that. You need to show us the project, and then we'll determine whether you qualify for that project, or the project qualifies for you, quite honestly, because it covers the income of the property itself, and all it has to do is cover whatever it is that you want to do with it afterwards. And so it's a little different approach. But when you're going in to talk to a lender, let's say you've got a project, you're getting ready to write an offer on it, or you have an offer and you're going under, you're doing your due diligence and you're under contract and you're beginning to dig into it, they want to see historical. They're going to go back. They want to go back 12 months. And then we find out, how has this operated? What has the income been like? Has it been up and down through the several months? Or if you can go back several years, has it been cyclical in nature? Has it been steadily going up or down? And what are the reasons for that? There's lots of market factors in terms of the demand versus supply that factor into this. And we can really drill down into that and find out if it's an undersupplied market or oversupplied. They're also going to want to see, what is the management that's in place right now? Is it a tired mom and pop operation where, they don't answer the phone, there's nobody ever in the office, and they don't have a website, and they're, they haven't raised rates in 10 years and they're $20 a month behind everybody else? Or, is it a well-oiled machine? Is it run very, very well, and they're squeezing every last penny out of it, which could be good. It'll cover your loan, but where's the value add if that's the case as well? But ultimately, especially starting out, Ruben, how are you going to manage it? They want to know, where's the expertise that you're going to bring to the table to be able to do this? And if you don't convince them that you're the one to do it, if it's a larger property, they may require a third-party management company, at least for a while, until you learn the business. So it's called global underwriting. The bank's going to take a look at the facility. Where's it trending? Where's it sit right now? Obviously, does it appraise? But really, in their underwriting, they want to see a 1.25 debt service coverage ratio, which means it brings in 1.25 times the monthly debt that's on that, so that you've got that 25% overage as a buffer, if you will, or the cash flow to make sure that it services that debt. So that, and then they begin to look into your credit worthiness, your experience, and your credit score, and then whether you have to personally guarantee the loan and pledge any other collateral or assets, or if not, then you have to bring in a guarantor partner that's going to assist with you on the loan.
Got it. I appreciate you getting into the details, because I think it's always helpful, and I want to give some tactical, practical steps to getting there, and I think you've done just that. The rest is on us. But let's talk about it. Look, there's no elephant in the room here. We're in this is a business. You got to make money, right? So I heard you say a keyword, which to anybody who's listening, your ears must have perked up. Value add, right? Because essentially we know that the more value we can add, the more we can gross, the more that our storage unit can generate more money and be worth more. What are, you talk about it, cement, slab, box. What's there to add? What do I do? What do I add? Like what, in this space, Scott, what are some areas that can separate yourself from the company next door?
Yeah. First of all, the beauty of commercial real estate is that there is no ceiling. When you're in the single family realm, you can improve this property so that it's you can over improve it. It's the nicest in the neighborhood. You can put gold inlay in the stair railings going up to the second floor. You can put $100,000 landscape package on this $50,000 house, and it's not going to net you anymore, except for the top of the market. There's a ceiling because of square footage and what the last properties have sold for. That's it. In commercial real estate, and especially in self-storage, there is no ceiling, because the value is based upon the net operating income. Regardless of the dollar per square foot or what others have sold for, appraisers do look at that to see what other facilities have sold for and traded for. But ultimately, this is a math exercise, and looking at, here's the income that it brought in last year in the last 12 months, here's the expenses, here's our net operating income. And then you divide that by a market cap rate. I think many folks are familiar with that. And depending upon where we're at in the market and where the facility sits, is it an A class, B class, C class facility, and interest rates, we're going to divide that, the NOI, by that market cap rate. And that's our valuation. So that's our starting point. So the good news is, if we have a facility that, just as I mentioned, it's a mom and pop that hasn't done a good job, maybe it's 50% leased, but you know what? They don't care. They paid the loan off. They're good. It's still bringing in money. They haven't raised rates in 20 or 15 years, and it's $20 below. It's like, we're happy at 50% occupancy, and we're the lowest in town, or we're happy at 70% occupancy, and we're the lowest price in town, whatever that looks like. The first things we do when we walk in is just that. We raise rates. We begin to market the facility properly, get a website in place, make sure that we're visible, call center to catch any calls after hours, and then we train a rock star manager to sit behind the counter. It baffles me how so many investors, when they get into this business, they think, well, I'm going to find the cheapest labor I can to put behind that counter. So I'm going to hire the gal that cuts my hair because she's really nice and treats me very well, and I'm going to pay her $9 an hour and then put her in charge of my $1 million asset. It's not the best way to go about this. So we want to get the rock star behind the counter that's going to drive occupancy and won't let anybody walk out of the office until they've rented a unit. And then they're going to add on locks, boxes, and moving supplies and offer those items to them, and renter's insurance. If they have a boat or an RV that they're storing, do we have a propane filling station run by a kiosk? Do they want a concierge service to get those items ready when they're getting ready to go? We have a lot of eBay and Amazon drop shippers, and so we will also offer to sell some of their items if they get behind and they're too busy, and we have a pack and ship service that we can offer them as well. And the list goes on and on, Ruben. There's many ways that we can add the additional net operating income to a facility, and then ultimately driving up the value. The biggest is by adding more units. Our model all along has been to find those facilities that are 4 to 5 acre parcel, but they only have buildings on 2 to 3 to 4 acres. And so once we fill it up and we raise rates, then we begin building the next building or buildings. And if we can, we'll buy the land next door or adjacent, behind, or even across the road, and maybe even down the road a little bit, and annex that and build more buildings there, and still having the office at the one location. And then we'll add a truck rental like U-Haul or Penske to it as well, which not only drives the revenue, but then also creates more traffic and door swings, because people that are moving need storage as well. So those are the most popular, but there's certainly more ways to be able to increase the value. But the value is always as a result of these businesses within this business and generating more revenue.
Guys, if you're listening to this, I have a grin on my face, because as Scott was mentioning this, it's, I hear vertical integration, which I love in business, of creating multiple streams of income under one umbrella. But, and maybe I actually misspoke on that, because one thing I'm going to follow up with you, Scott, on is it under one umbrella, or now you're forming strategic partnerships so that you're getting like a haircut, or do you keep everything in house? How do you structure the U-Haul and the lock boxes? I'm sure those, I'd love to hear a little bit more on that.
Yeah, a little bit of both. The good news is very little cash outlay for a lot of these. And so U-Haul that's an agency relationship. So we sign the paperwork, they train the manager behind the counter and set them up with the computer. They make the reservations and they send the person to our store, our site, and we have the truck out front there, and they fill out the paperwork by walking around. We collect the money from them. Sometimes, typically it's all handled through their call center, and we send them on their way. Same thing when they come back, we check the trucks in, and there's a little box that they put their keys in, and we collect a commission as long as we have the ability to park trucks somewhere on our site, preferably by the road. And then we have a dedicated line where they send the leads to us, and we just collect commissions from that. And again, it is a great way to be able to rent units, because people that need a moving truck typically need storage. Vending machines, you can buy a vending machine at Costco or Sam's if you want, but we just have the vending machine companies come out, and it's a revenue share. We give them a concrete slab, and we already got it in an outlet. We plug it in, and we get a revenue share off of that. We'll order the $500 kit of locks, boxes, and moving supplies, and it comes with the pegboard and the hooks and everything, and we stick it on a wall. And by the time we've rolled through that first $500 worth of inventory, everything else is gravy after that. It's a keystone markup. It's 50% on top of what we paid for it. Renter's insurance, same thing. We don't sell insurance, we offer it, and the insurance company gives us the spiff on top of that. So these are businesses within a business, but they're almost all set up as like an agency type agreement, where we're not supplying the services, we're not building the marketing, the back end, or the products. We're just signing and getting a cut of these businesses, and we become kind of joint venture partners with these folks.
I love that, because and it goes back to what you started the theme with of your entire blueprint, and probably one of your core values. It's focus, right? You're focusing on what you're good at, and then you're forming strategic partnerships with the folks who are good at what they do. But it's allowing you to supplement your existing your business as well, and the experience of that user. And I love the vending machines. I didn't even think about that. That's fascinating. So let's talk about the who, because I think one thing people they hear self-storage and thinking like it's interesting because there's the mom and pop or the Joe next door who's storing some things. But I heard you say something key, and I'm not sure that if that was an anomaly or something that's maybe more common practice now. I heard you say maybe like an Amazon storage, and I know fulfillment by Amazon, and e-commerce is blowing up as we know it. And I specifically have heard how with this increase in demand or I say fulfillment, etc. That's where the opportunity is. Are you finding that some of your, avatars or current clients are some of those folks? Maybe they, because fulfillment by Amazon, I mean, I know that's a whole different business model. You let Amazon do the fulfillment and storing, but I'm wondering if there's, and I've been in the space too, like white label, Sure. So do you find that there's a growing maybe clientele of that too? Because I think it's important for people to start collecting these trends, or maybe I just misheard or misspoke. I want to hear from you.
No, you didn't mishear me. So we're multiple ways of being able to hack the Amazon phenomenon that has happened during COVID. So, this goes back to the recession of 2008. I was in storage at that time as well. And when the economy tanked and so many people were out of work, Well, many of those folks began making ends meet and even making a living out of selling items on eBay. So that was, obviously Amazon was around and everybody was ordering, but a little bit different this time around in terms of the pandemic. And so we come to this place where people are getting used to buying online already, and then all of a sudden, come March of 2020. Everybody's forced to, if they're not already, they're forced to learn how to buy things online, whether it be through Amazon or any of the thousands or hundreds of thousands of retailers, and bypassing the retail stores. So even before that, there's a lot of folks that were buying in bulk or becoming an Amazon drop shipper. So they were white labeling, or as you mentioned, they're buying directly from the source and then selling on Amazon and setting up their own store or on eBay as well. And so, the cheapest space, once they run out of room in their garage or the basement, or once their spouse kicks them out of the house and says, go run your business somewhere else, then the least expensive space to be able to store things is in a self-storage facility. And so they'll come in and they'll take our 10 by 10s, and then they'll move into a 10 by 20, and then they'll get two 10 by 20s, and they're running their business out of Starbucks or their truck and a laptop, and their inventory is stored at a self-storage facility because that's the least expensive space that they can find to be able to run it from there. So we have a number of folks that are truly running their businesses out of a self-storage facility and paying $100 a month for their warehousing and for their overhead.
That's amazing. Now, Scott, you have a lot of experience, and so I may be getting too creative here in my head as you're, I'm getting all these ideas. I'm getting insight. So I want to hear. So I'm aware, from what I understand, that there is a model in commercial real estate where you can do, let's say, your different lease terms, right? So if you're, let's say, a restaurant, maybe you give a certain percentage of your proceeds as part of rent. Is that am I saying the right thing? Is that still commonplace, or is that a thing?
It is, and it can be. We try to stay away from that only because when it comes time for valuation, if you're going to refinance or if you're going to sell, we want to see all that money coming in. Because again, our valuations are based on the income minus the expenses, and so you could argue that you could get to that same place if you're bartering rent or giving a share of that in businesses. But at the end of the day, for valuation purposes alone, we would rather just have exchange the money for the rental space, because that benefits us on the back end.
You got it. All right, right straight to the numbers. I heard you say 10 by 10, 10 by 20. Give again, you had over 2.2 million of square feet in this, over 13,000 units. For us, let's tackle one deal at a time. What does it look like? What do you typically like to go for? And then let's talk about what people are typically renting these spaces for. Yeah. And then we'll get right into the overhead numbers, because I think they'll help us package all this juice that you gave us today. Give us a little perspective, a little taste of Scott's world.
All right. Well, I don't want to burst your bubble, Ruben, and I can just answer that question by saying it depends. How's that? Because it does. I mean, you could rent a 10 by 10 unit, temperature controlled in LA for the same price that you would rent a single room apartment here in Indianapolis. It is very market dependent, market specific. So, how much do you pay for the land determines, how much the overall cost of the facility is. And self-storage rent, really, it tracks with apartment rent in a market for the most part. There's roughly the same delta between the two, because we're looking at, median incomes, and that's just how the market, I can't even say but that's kind of how the market sets the rental rates. So most of the facilities that we're looking at least, the folks that are going to be looking maybe for the first time, they're looking for a facility that's probably in the $1.2 to $1.5 million range. And I know that may sound like a lot to some of you, but as we just mentioned, Ruben, that's the easier way to get into the business. That's what the banks are looking for. And that's going to it's going to throw off enough cash that will allow you to have a manager in place so that you're not behind the counter. So make sure everybody gets that out of their head. But if we're looking anywhere up and down the Eastern Seaboard, outside of the major metro areas, downtown metro areas, then that's going to net you a facility that's going to have probably 250 to 350 units, and your average 10 by 10, again, in most of those markets, anywhere from $75 up to $120. And I know that's a big swing, but again, it depends upon the market, and higher if it's closer to the downtown metro area, like Atlanta or like Miami or any of the other major cities. So that's I know that's a wide range, and I don't want anybody to hang their hat on that, because once you begin digging in and looking in your market, you'll see immediately, based upon the median income and where it's located, your competitors within a 5-mile radius, they're all going to be within about $2 or $3 per month per unit. They're all going to be very, very similar, and then that's what you base your numbers on as you do your underwriting and then make your projections. Does that make sense? Does that
No,
answer
it
your
does.
question?
No, it does. It does. And I think that's important for people. I do want to make sure this one doesn't slip through the cracks, where what you're really saying, Scott, is when you go bigger, you can actually justify the reasons to have and be able to afford as well, not only cover your debt coverage ratio, but at the same time, be able to go big enough to have management in place, because again, we want to work on the business and not in it. And I think that was important that you mentioned that. As far as the value add, are you moving, again, I know it's not comps driven, but you mentioned $2 to $3. What are some little small things that, I guess you've already talked about adding, unique elements that will bring in more cash flow. Is that what it is really? You're not really playing around too much with the market rent, because someone will go elsewhere and go across the street. So you're more focused on bringing additional revenue, or maybe did I miss that? Like, I want to hear like how that looks when you're trying to squeeze as much, and squeeze maybe is not a good word, but like give as much value and charge for as much as you can without scaring away your current tenant, or I should say, or so that they don't go across the street. Client. Yeah. How do you do that?
So, that's where it comes back to being lumped into all the other forms of real estate, where you need to go do a good job. And if the facility isn't up to par with the rest of the market and your competitors, then it starts at the curb with curb appeal. It starts with signage, cleaning that up, making it nice and neat and clean, and landscaping around it. It's very well lit in the evening. You show security by way, if it doesn't have a fence around it and your competitors do, you're going to be putting up a fence. There's electronic gate and gate code for access to be able to get in and out. When they walk into the office, it's very nice and bright and shiny. It's welcoming. When they walk into the counter that faces them, the person on the other side stands up and greets them. And right behind them is a big old monitor that shows, all of the cameras and the security system to show how safe and secure this place is, so that when they walk in, they can see all of this, that they're, even though they're not going to live there, their stuff is going to enjoy staying there. And that's what we want to portray. And to be honest with you, Ruben, that's what we want for the website, because better than 80% of all our rentals are done on our smartphones or by way of a laptop these days, because we have the ability and the technology to be able to do that. So it's all those things in real estate that we do to beat the competition, to get them in. But don't mistake the fact that people aren't going to live here, so they're not going to shop. They're not looking for the best school system, and check out the neighbors, or if it's close to a park or playground. It's usually the person who gets stuck with this in a household with a mom and dad. It's mom. She gets stuck with this task. And along with all the other things she has to do, she's going online and she's looking for something close to her. She's going to look at a couple of facilities and the rates. And if she can get that information online, then, she's 90% of the way there. And if she finds one in which on her mobile phone, it has a website that is mobile ready, and she can reserve a unit or rent a unit on her phone and check that one last thing, off of her to-do list for the day, that you win. So it begins with curb appeal, nice, clean, accessible, safe, secure, and easy for somebody to rent a unit and to be able to access and get into their facility. And especially in today's environment, to be, a hands-off transaction, where we are contactless. We are offering touchless rentals, and in the storage industry with kiosks and, the ability to do this with a mobile device. I mean, we've been offering touchless rentals before it was cool to offer touchless rentals in this COVID environment. And it is an essential business that never shut down. And so, again, another reason why we were ready for the call when it came, and it has benefited during this time. And we did not have a blip in our operations or one hiccup, because we were already prepared for it.
I love that. I love how ahead of the curve you were, and you talk about it being recession proof, and to your point, again, whether it was planned or not, I think you're on the right side of our current times. And I love that contactless. And another key where you said easy, making it easy for a consumer, for a client to do business with you, making it the next obvious step.
Yeah.
I think that's really important if you're listening right now in any business that you're in. And, it's fascinating because I opened up the conversation by saying you kind of see, the reflection of some of the core values that, take place. And I'm hearing it: focus, it's customer service, it's doing your research. I mean, it's all the unsexy things compiled into multiple steps that bring in the formula of why you've had so much success. And to put things into perspective, again, you have multi-million-dollar businesses and multiple. I want to get into this last one is a little selfish for me because I love the reason why we have these labs is to give people insights, to get people educated. And you have a self-storage mastermind, self-storage academy. I mean, you're doing a lot of things to give people insight of, hey, not only can I educate you, but you can also do it with us. What has been the most fulfilling part of that for you now that you've kind of even created another business model out of the success that you've, again, created with your team?
Yeah. I get to help people achieve their dreams, their lifelong goals. Simple as that. This business has been good to us. It's not a simple business, but it is a predictable business model that if you follow the steps and you do it right, and, you follow the path of somebody who's walked before, and you cross your T's and dot your I's, as you mentioned, this can be a business that is all that you want a business to be. And so coming from the place that I was in real estate, again, passionate about real estate, passionate about fixing things up and making it better, and passionate about offering that for rent so people can pay down the basis of these, pay them off, and provide a retirement for me at some point when I decide to slow down. But to be able to do that for other people and help them get out of a job, or to make enough passive income in self-storage to bring a spouse home to raise the kids, or vice versa, or to just ultimately retire early, or just not have to worry and go on a vacation and not have to have a cell phone nearby because you were in the rental business before and you couldn't dare leave the phone behind. Self-storage is as unsexy as it is from a business model standpoint is extremely sexy because you can operate this business without a lot of input once it gets up and going, and allows you that freedom and the cash flow to be able to go out and do what it is that you want to do. So we designed it for our lifestyle, and now we've opened that up and share it with other people and allow them to achieve their dreams as well.
Love it. All about giving back comes full circle. Listen, we're going to end this the way we started it. I said, I had the luxury of having you here in the lab with me, where I get a chance to, ask you questions. You've been super insightful. I opened up the conversation by saying that, you are a true reflection of how well your business is doing. And again, you haven't, you never cease to impress me, of course, Scott. So I appreciate that.
Thanks, Ruben.
But I definitely want to take the opportunity to ask you quick fire round questions.
Yeah, sure.
And we'll go from there. So tell me, you seem like a very insightful guy. What is one of your favorite books that you feel has been a good blueprint to your achievements in your journey as a business owner?
Oh gosh, yeah, there's a whole lot. I'd say one that we go back to over and over again is, Think and Grow Rich. I mean, I'm sure that's been said on your podcast many times before to get people in the right mindset, and that's what allowed us to start our mastermind. But Traction, also by Gino Wickman, is the entrepreneur operating system, which I know you're familiar with, Ruben, and that's at the core of I think many entrepreneurs' businesses, and it's that's been a game changer for us. So yeah, plenty more, but and I'll just say the one thing by Gary Keller as well, who built Keller Williams, which I definitely know that you're familiar with. So good stuff. All good reads and many more.
Absolutely. I'm not surprised as the focus man that you are. One question I'll ask is what daily habit best serves you every day? Daily habit, do you think?
I think I guess the whole morning routine is, I get up early and grab a cup of coffee, and I go for a little gratitude walk before I hit the gym at 5:00, and spend a little quiet time, a little time with God, and then sit down at my desk about 7:30. And if I follow that routine every day, first of all, it seems like I'm cheating when I'm getting up that early, and getting all those things done before 7:00. But that's I can't say it's the one thing, but it's the those three things that I do that start out every day that just gets me ready for the rest of the day.
Fascinating. Love it. I'm a big Miracle Morning guy as well.
Yeah.
Love that. One best tool that you think, again, it could be a notepad, it could be an application, best tool that helps you execute throughout your day?
Golly, caffeine is the first thing that comes to mind.
That's funny.
um, there's a lot. I like multiple screens. I operate from
Yeah.
3 screens, and to be able to have information at my disposal. And aside from that, if we were looking at apps or anything else, it's probably my assistant who is running in our project management software. We do traction. We do it with property management software, and I do it with a lot of data at my fingertips. So I know that's more than one, but I think getting to that place where you have systems and people that are, in their own lane, giving me the data, and we have up-to-date dashboards as to what's going on instead of fumbling around looking for stuff all day long.
Yeah, and if you're listening, be careful. Once you go to multiple screens, you can't go back. So
You can. And when I travel, I had to get a travel one in my bag that hooks up with a USB. So even if I'm at a coffee shop, I got it out, and other people are looking at me, but I have to.
I'm not kidding. Look, it is extremely efficient. I have two. If I go to three, Scott's going to get me in trouble. So I know what I'm getting myself into. I might not do that, but it is a game changer.
I'll give you permission. You can spend the money.
Yeah, I know. Definitely. Last but not least, look, biggest misconception. I know you give a lot of gems. What do you think is the biggest misconception about self-storage? And then I'll have a follow-up to that is, what is one thing you wish you would have maybe done earlier in your operation as a self-storage operator?
Sure. So I think the biggest misconception is, and I hope I'm not a victim of my own marketing, but we've been teaching people about this for 15 years, and it is of the real estate asset classes, and except for parking lots, but you can't really build a lot of value into those. It's one of the simplest asset classes in all of real estate to be able to buy, manage, operate, and run and evaluate even. But I think what happens then is people think the misconception is that, well, I don't have all these moving parts. I don't have all the tenants and toilets and trash and have to, do all the move outs and the clean outs and everything else that's involved in that. And so, I heard this one guy say in a podcast that it's a metal box on a concrete slab and it's a set it and forget it business. And it's not. You have to walk the four corners of your business. It's a business. You have to walk the four corners of your business. And you have to mind the storm. You got to keep up on the competition. You have to understand, what's going on in the capital markets when you buy it, and you need to know how to analyze one of these things. You need to get real good at underwriting it and doing your due diligence, because just like any investment, and not to sound like a broken record of everybody that comes on here, Ruben, but you got to understand what you're doing and get some education before you jump into this, because you make your money on the buy. You don't make it, and try to make it up on the back end or try to make it up during operations. If you make a bad decision and you overpay by $200,000 or $300,000 or $500,000 on the buy, it's kind of hard to make that up. And sometimes people don't make that up and they end up, losing the business. And so I think that's the biggest misconception, is people just think it's easy and will trust the broker's numbers because they work for one of the big brokerage houses. And why would they make these numbers up? And well, they get those numbers from the seller. And if you don't know what you're doing and you miss a few here and there, or if you didn't really do the due diligence to dig into it, it's too late once you bought it. So I'd say that's probably the biggest. People just don't know what they don't know and they get into it anyways.
Well, if they haven't heard gotten anything from this, is if you're going to be the set it and forget it guy, Scott's going to fly right by you because he's running a business, and that's how you should operate it as well. And then the last part was what's one thing that you feel maybe if you had known earlier that you wish you would have maybe implanted maybe 10, 20 years back that today? Is there anything that jumps out at you?
It is. Yeah. There's a gentleman, I can't say he was a mentor, but is I guess a mentor that came across my life early on. And I was just very averse to partners. I grew up youngest of four. I kind of did everything on my own. I don't want to listen to teachers. I don't want to listen to bosses or anybody. I just want to do my own thing. So I never wanted to bring on any partners. Part of that was, I can do it all on my own. And perhaps I think pride gets in the way, and I kind of want a little bit of the limelight to say I can do it on my own. Yeah. And this gray-haired gentleman said, man, I've always had partners. I can't imagine doing anything on my own, because, when you leverage the resources of other people in terms of how much they know and their experience that they bring and your money and your credit, there's no way I would have been able to build my business to the level that it is and get to where I am right now, and as fast as I did. And I just thought, oh yeah, well, I'll show you, and maybe that works for you, but I'm just gonna keep it all and do it myself. And then now when we've gotten into that place where, eventually you run out of cash, and that's the fuel for the business. If your credit's great and you got a supply of projects coming in, well, your growth is limited by the amount of capital that you have. You have to inject capital to buy more deals. And so instead of growing slower, had I learned how to syndicate and bring in private equity and other partners that had capital and lending resources, yeah, we could have grown a little bit bigger and done that a little bit faster had I just swallowed my pride a little bit and decided to take a good hard look at safe ways to be able to bring in a partnership and be open to what other people can bring to the business.
Yeah,
because I sure get it now.
absolutely. I'm so glad you said that, because I
Mhm.
do feel that sometimes as entrepreneurs, we do have that chip on our shoulder.
Oh, sure.
Because we've had
Mhm.
that, that friction where people are telling us, "Are you sure you're gonna make it?" Whatever, and then you kind of want to prove, but
Mhm.
you gotta
Mhm.
really, mature, put the ego to the side. I think was what
Yeah.
it is, and
Mhm.
you can build something special. I mean, you're gonna
Mhm.
build something special with a team, or with partners. You're
You're
gonna have to.
absolutely right.
So-
100%. Mhm.
Listen, Scott, you came in, you talked about self-storage, but you certainly did not store the information for yourself. So we appreciate that. You came in, you dropped some nuggets. Where can the people find out more about what you're doing, Scott, and what you and your
Yeah.
operations and multiple companies are doing? Give us the plug, man.
Yeah, you can find me anywhere on the socials, either the Storage Guy or Scott Meyers. We're out there all over the place on Facebook, LinkedIn, and yeah, anywhere on the socials. But if you want to go start to pull down some information, I feel a responsibility, and we give back by giving people a lot of free information so that they don't make a mistake, at least get off to the right foot, and give them the questions that they should be asking. So go over to selfstorageinvesting.com. There's a ton of free resources. Poke around, take a look at what we've got to offer to, assist anybody who's looking to start or scale a self-storage business. It's all right there.
I can't thank you enough, and we will be sure to include that in the show notes. If you're driving, keep your hands on the wheel. And just like that, we thank you, Scott. And on that note, we are out.